All right, let's dive into a real head scratcher from Wall Street. You ever see a company report what looks like a great quarter only to watch the stock just completely fall off a cliff? Well, that's exactly what happened with i3 Verticals after their latest earnings. So we're going to break it all down, what went right, what went wrong, and what it all means. So first things first, let's just look at the damage. I mean, wow. On the day of the earnings call, the stock got absolutely hammered. It closed down 10.5%. But get this, at its lowest point during the day, it was down almost 24%, hitting a brand new 52-week low. I mean, just a truly brutal, brutal day for anyone holding the stock. But, and this is where it gets interesting, the actual results were really strong. The company didn't just meet expectations, they beat them. They beat earnings estimates by a solid 13%. So you've got this complete disconnect, right? A great report card on one hand, and a stock that's just in an absolute free fall on the other. And that right there is the million-dollar question we're digging into today. Why such a violent reaction to what looked like a perfectly solid quarter? Well, as you're about to see, it all boils down to that age-old Wall Street battle. What a company did versus what it's going to do. Okay, so let's start with the good news first, because honestly, there was a lot to like. When management stepped up to the mic for that call, they had a really strong set of numbers to talk about for both Q4 and the full fiscal year. It really looked like their big strategic shift was paying off. Just take a look at these headline numbers. We're not talking about a tiny beat here. These were clean, solid beats. Adjusted earnings per share came in at 27 cents. That's a good 3 cents higher than what Wall Street was penciling in. And revenue? Yep, that topped expectations too. So if you're just looking in the rearview mirror, this was an undeniable win. And when you pop the hood and look at the engine, the underlying software numbers looked even better. Management was quick to highlight things like 23% growth in their really high-quality SaaS revenue, and look at that net dollar retention, 104%. That's a great number. This was supposed to be the proof, the hard data, that their big pivot to a recurring revenue software business was actually working. But as we all know, the stock market doesn't care about yesterday. It's a forward-looking beast. And the party for that strong 2025 performance came to a dead stop. I mean, a screeching halt, the second management started talking about their outlook for 2026. This, my friends, is where the whole story just fell apart. And this right here lays out the problem in plain black and white. Just look at the guidance for 2026 revenue. The midpoint is about 4% lower than what the street had baked in. Okay, not great. But then look at their earnings forecast. That missed by an even wider margin, almost 8%. You have to understand, in the world of high-growth software stocks, a miss like that is, well, it's more than enough to hit the big red panic button. Yeah, this chart really drives the point home, doesn't it? On the left, you see the solid revenue they just posted for 2025. In the middle, that's what the company is guiding to for next year. But look at that third bar on the right. That's where Wall Street thought they would be. That huge gap between the company's forecast and the market's expectation, that's the air pocket. That's the reason investors stampeded for the exits. So the natural question is, why the weak forecast? What happened? Well, management basically pointed the finger at a slowdown in their professional services business. They tried to frame it as just a temporary hiccup, some projects getting delayed. But they also said it was a deliberate choice. They're choosing to focus on locking in those juicy long-term SaaS contracts instead of chasing short-term services revenue. And that plays right into their bigger long-term strategy. So you have to understand, this weak guidance didn't just come out of nowhere. It's really a speed bump on a much longer journey. They're in the middle of this massive, multi-year transformation. So let's zoom out for a second and look at the big picture of what they're actually trying to become, a pure-play, government-focused software powerhouse. And their game plan is actually pretty straightforward when you lay it out. Step 1, sell off the businesses that don't fit, like merchant services and healthcare, to really simplify their story. Step 2, go all in on public sector software. Think courts, utilities, that kind of thing. Step 3, keep pushing that all-important shift to SaaS and recurring revenue. And finally, step 4, with all that cash and no debt, get ready to go shopping for some smart acquisitions. And speaking of acquisitions, the CEO, Greg Daly, basically sent up a giant flare on the conference call. This quote says it all. What he's really telling you is, 1, our balance sheet is a fortress, and 2, we are ready to do some deals. You can bet that $85 million in cash isn't just going to sit there gathering dust for long.
So yeah, despite that guidance stumble, management was really trying to get investors to look past the short-term noise and focus on the foundation they're building for the future. You've got a debt-free balance sheet with a pile of cash. They're now able to push through price increases every year. They landed this huge flagship contract win with the West Virginia Supreme Court, and they keep talking about a strong but disciplined pipeline for M&A. This is the long-term bull case in a nutshell.
All right, so that's the story of the quarter. A really strong past running smack into a much cloudier future. Now for our favorite part. Let's put on our analyst hats, synthesize all this, and talk about what this means for the stock from here on out. Here's our take. The entire narrative for i3 Verticals is shifting. It has to. With their organic growth story kind of hitting the pause button, all eyes are now going to be on M&A. The question that every investor should be asking isn't about organic growth anymore. It's about capital deployment. It's how and when are you going to spend that cash? So what does that mean for the stock price? Well, honestly, we think it's probably stuck in the mud for a little while. The stock is likely going to trade sideways, just treading water until one of two things happens. Either management proves this slowdown was just a blip by raising their guidance, or they go out and make a meaningful acquisition that gets investors excited again. And that brings us to our final rating. We're calling this a market perform. Look, the long-term story, the transformation they're trying to pull off, it's really compelling. But right now, it's just completely overshadowed by these immediate-term growth questions. This has officially become a classic show-me story. They have to prove it. Okay, so how could you trade this? Let's talk ideas. The bull case is pretty simple. You say this 10+% drop is a massive overreaction. You could use this weakness as a chance to start a position, basically betting that management will announce a smart, creative acquisition sometime in the first half of next year that acts as a huge catalyst for the stock. Now, the bear case? It's that this services slowdown is actually a bigger problem than they're letting on. They don't get any deals done, and the stock just becomes dead money, lagging behind as the rest of the software space takes off. So there you have it. That's our full breakdown of a very, very eventful quarter for i3 Verticals. Definitely a lot for investors to think about. And as always, please remember, this is not financial advice.